The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Welcome, everyone. I apologize. We've had some technical glitches getting started, but we're all here now. My name is Vinay Navani. I'm a tax partner at Wilkin & Guttenplan, and we're going to be talking today about some of the tax provisions in the CARE Act. Joining me today are going to be two of my colleagues, Karen Arta-Sanchez and Len Nitti. Both Karen and Len are tax partners in our firm. I work very closely with both of them. Karen has her focus primarily on the corporate side of taxation, and Len does a lot of real estate work and partnership taxation, and together we've been kind of really immersing ourselves in the CARE Act and looking at the provisions that can help our clients that are having these difficult times use some of these tax incentives to help free up cash flow, to help their businesses, help continue to pay their employees, and see what the take the most of these benefits that are available. So just some housekeeping items, and just bear with me. I'm trying to move the slide. It doesn't seem to want to move. There we go. Just some housekeeping tips. Part of the CARES Act, it was enacted in such a hurry due to the coronavirus crisis. A lot of the legislation was more conceptual. The legislation did not have a lot of the details about implementation in it. As such, the details about how some of these provisions are being interpreted are changing literally by the day. So if you're listening to this later, today's April 16th, but we really finalized this work as of yesterday and the day before, so April 14th. So keep that in mind. We do have a chat function. Feel free to send us whatever questions you can. We'll try to answer as many as we can on the presentation, and anything that we don't get to, we'll try to respond by email. And an archive of this will be up on our website, and you see the URL there to listen to it. Probably in a day or two, we should have it available. So I'm going to spend a few minutes before we get into the kind of the substantive tax issues about the tax relief that the IRS has given due to the coronavirus. So the overall theme of and just like what I said before about the things changing by the day, the tax filing relief has literally been changing by the day as well. I've never seen a situation where we've had several successive IRS pronouncements gradually, broadening the relief. So there's basically three ways that I look at it. We have extensions of tax return due dates, extension of tax payment dates, and extensions of critical deadlines for certain time-sensitive actions. And effectively, the theme is anything that really was, most things that were focused on April 15th, 2020 have now been postponed till July 15th, 2020. So we've gotten a little bit of a reprieve on some of the things that had to have been done by yesterday. And what's not included? Most of the relief does not address payroll tax returns and payments, although there are a bunch of incentives in the payroll tax area that Karen will be speaking about later. And we've not seen much on the excise tax world. So keep that in mind if you are working with those types of taxes. There is not the broad-based relief as you'll see in the other income tax provisions. So this is kind of a list of the main different areas of income and estate and gift returns that we typically see. Personal returns, obviously, a Form 1040. Corporations, both what we call C corporations and S corporations and foreign corporations, cooperatives, homeowners associations, partnerships, which is your Form 1065, estates and trusts, Form 1041, estate and gift taxes, and tax-exempt organizations. So all of those broad filings, if they had due dates on April 15th or before July 15th, for the most part, they've been pushed back till July 15th. Now, when I first started looking at the time-sensitive actions, I said, let me go start making a list of the things that were extended, and that you'll see in the Revenue Procedure 2018-50, and it got to be too long of a list. There are a number of things. Things like if you're changing your accounting method, there's a certain deadline to file that with the IRS. If you have a net operating loss and you're trying to carry it back, there's a certain day to do that. So there is a long laundry list of items in Revenue Procedure 2018-50. If you have a like-kind exchange and you have reinvestment property, time sensitive, that has been released. So, or extended, I should say. So look at that revenue procedure if you're dealing with something that's not a tax return filing date or payment date. And two things that the most recent notice did bring up was if you are filing a petition in a tax court, there are very tight time deadlines for that. That has been given some relief, as well as if you're filing a refund claim. And that typically refers to a 2016 1040, which would have been due on April 15th of 2016. The 3-year mark would have been, 2016 would have been due April 15th, 2017. That statute of limitations expired on April 15th, and that's been pushed back till July 15th, 2020 as well.
Okay. Vinay, let me interrupt you for 1 second. If somebody in the audience could type into chat and let us know if you can hear us. Amanda mentioned that some of the attendees are having a difficult time hearing. So if somebody could chat, if you do hear us, so we know at least it's working for some.
Otherwise, we're just speaking to ourselves. Okay. And I see people that are chiming in to say they can hear us. So thank you all of you who are responding.
And
Thanks,
I guess maybe those who can't hear, try and log off and possibly rejoining. Maybe that will fix it.
Yes.
Okay.
So we talked about tax filing relief. We talked about estimated tax payments. We talked about time-sensitive actions. So let's talk about estimated tax payments. So the general rule when you're filing tax extensions is that yes, you can get an extension from April 15th to October 15th, but you still have to pay the tax on April 15th. Otherwise, you'll have a penalty if you owe money when you file your return. So those rules have kind of shifted. What was April 15th is now July 15th. So any payments that would be due between now and July 15th are now due on July 15th. So for a calendar year, individual or corporate taxpayer, you would have your amount due with your 2019 return that is now due July 15th. Your first quarter 2020 estimated tax payment, which would have been due April 15th, 2020, and your second quarter 2020 estimated tax payment, which is due June 15th, all done on July 15th. So the good news is there's quite a few payments that can be deferred. The bad news is there could be a very large payment due on July 15th. So you need to budget for that. And you need to take a fresh look at how you're looking at your estimated tax payments, because in many years, we typically base our estimated tax payments on the prior year. And given what's happening in 2020, for many taxpayers, it's not going to be business as usual. And they may be paying a significantly lower amount of tax. So, by May, June of 2020 is a good time to reassess where you are and maybe adjust your estimated tax payment calculations. So how do you take advantage of the relief? There's really nothing to be done as long as you qualify for the relief under Notice 2020-23, meaning that you have a type of tax that's due or filing a type of tax return that's described. You simply file it on July 15th. There's no extra time or no extra forms, anything that's required. I gave an example in the slides that you'll see of a June year-end corporation that's tax return is ordinarily due September 15th. If that corporation took another 6-month extension that it's allowed to do, it would typically be due on April 15th. And that corporation is now extended to July 15th. And at that point, there's no further extensions. If I am a calendar year individual, for example, I go from April 15th to July 15th. If I'm still not ready to file my tax return, at that point, I would file my normal extension form and request an extension until October 15th. And I would have to make sure that I pay in the right tax on July 15th as I would if it were April 15th. and that is what I want to talk about, tax filings. I'll just make one other comment that the IRS has also been sending out announcements about how the IRS is virtually shut down in terms of in-person assistance. So a lot of things that you may be trying to do with the IRS is going to be very difficult to get responses for. So I don't have a great solution for you. Just know that the IRS is in terms of its manpower is kind of at a standstill as well. So with that, I think we're going to go. Karen is going to talk to us about some of the payroll tax credits that are part of the CARES Act.
Yep.
Karen?
Thanks, Vinay. And just before I move into this, just one thing, not that we're really talking a whole lot about the states, but as far as the payment due dates, you want to make sure that you check with the states, because not every state has gotten on board with extending the payments or mirrored, the new due dates, according to the IRS. So as an example, New Jersey's second quarter estimated tax payment is still due June 15th, even though the federal payment is due July 15th. So
yeah,
great. Thanks,
Karen. The AICPA has a great resource on their website that anyone listening can use, which gives a lot of details on what the states have and haven't done.
Yep. Okay, so moving into some of the benefits that are available, it's hard to believe that it's really only been a month since the FFCRA was passed, but that's the Families First Coronavirus Relief Act, which was signed by the President on March 18th, 2020. And as with many of these relief provisions, one of the purposes was to ensure that people who couldn't work due to COVID-19 circumstances continued to be compensated, and getting paid under new mandatory sick leave and family leave provisions. So these provisions applied to small and mid-sized businesses, which are defined as those with less than 500 employees. But not all employees are eligible for these sick or family leave payments. So there's two circumstances that permitted an employee, or required an employer rather, to make payments to an employee. And without going into all of the details on what those circumstances were, I'm going to refer to them as a direct impact or a caregiver impact. The direct impact basically being, you yourself as an employee were directly impacted. Either you were sick or you had to stay home, you couldn't work. And the caregiver impact is you had to stay home to care for somebody, whether it was, a family member or a child. So again, one of the goals was to get money into the hands of those who, needed it quickly. And from an administrative standpoint, as we're, seeing with, these rebate checks that Len's going to talk about a little later, from an administrative standpoint, if putting money, these, sick payments into the hands of the employees were left, to the government. Administratively, it would have been a nightmare, and it would have been a very long time before anybody got any money. So what happened was the burden for making these payments was shifted to the employers. And in exchange for that, in order to make the employers whole from a cash standpoint, they built this payroll tax credit into place so that the employers would get a refundable tax credit to offset the cost of this paid leave. Then now you can shift slides, please. So the credit is equal to the sum of qualified sick leave wages, qualified family leave wages, qualified health plan expenses, and the employer's share of Medicare tax. So again, this is, just specifically for these wage payments. The credit is also applicable only to payments made for this mandatory leave during the period from April 1st through December 31st, 2020.
Did I go too fast?
Rate, yeah, go back. Sorry. So the rate, so the difference, the reason that I differentiated between, a direct, the directly impacted individual or the caregiver impact is because the rate of pay that was required under those two circumstances is different. So for sick leave, an employee is entitled to a maximum of $511 a day for 80 hours over 2 weeks. So that's basically, $5,110 max. And for a caregiver, the maximum payment was $200 a day for, 2 weeks basically. So that's $2,000. On top of that, if you were required to make these mandatory family leave payments, that's an additional $10,000 max. It's $200 a day for an additional 10 weeks. And the only time that those payments kick in is if you have an employee that had to stay home to care for a child whose school was closed. So the credit is basically you add up all of the wages under these couple of scenarios, and that's the amount of the credit that you are entitled to. Okay, next slide. So now we move into how do you claim this credit? And basically, because it's a credit against payroll taxes, it's going to be claimed on your quarterly federal payroll tax return, Form 941. Probably not for the first quarter. We're going to talk in a little more detail about how to claim this credit. But it's basically, employers are going to be able to offset the employer portion of Social Security taxes. So what the credit doesn't offset is withholding that needs to be paid in, or the employee portion of Social Security taxes. However, if the credit, and again, that's the amount of wages that you pay, if that exceeds the taxes that are eligible to be offset, which is the employer piece of Social Security, that excess can be refunded. So what you can do, employers in order, I guess one of the challenges with this and the mechanics of this is that in order to make these payments, the employers need cash. So what the rules allow you to do is hold on to your cash by reducing the amount of taxes that you would otherwise be required to deposit. So I know this sounds, kind of confusing, but again, if you think about, you're only allowed to reduce or claim a credit for your portion of the Social Security taxes. That doesn't eliminate your requirement as an employer to deposit withholding taxes or the employee piece of Social Security tax. But the IRS is allowing you to hold on to that cash, and to pay to continue to pay these sick and family leave payments. Additionally, if you know that, after you estimate what your total, credit is going to be, and that exceeds the amount of these other taxes that you're still going to have to remit, you can apply for an advance payment of this credit on Form 7200, which is a new form that was released, which I'll talk a bit more about in a minute.
So, Karen, if you're done, let me ask you a question. I've got a client that they're pretty small, and to have, they are telling me it's a hardship to have to make these payments. Are there any outs?
Yeah, that's a great question. So while the provisions are mandatory, meaning that if you have employees that are, either, will either qualify under the sick leave or the family leave, if you're a business with less than 50 employees, you can actually claim an exemption from these rules, provided that you can show that making these payments would jeopardize, the viability of your business as a going concern. So that's a really good question. There is an out for very small businesses.
Okay, thanks. So I think now you're going to switch gears and talk about the employee retention credit.
Yep.
Right. So here we go.
So, yet another payroll tax credit that's out there. So again, if you think about what's happening, in the world right now, there's a lot of people who, who are unable to work either because they're sick or because their businesses are closed or they've been, furloughed or whatever the case may be. So as an incentive to, help keep the employees paid with money in their pockets and everything, this employer retention credit was built in as part of the CARES Act. So this is a fully refundable tax credit equal to 50% of qualified wages, including health plan expenses. So an eligible employer is one who has carried on a trade or business during the calendar year 2020. This includes tax-exempt organizations. So while many businesses, just under that thinking about there's, millions of businesses out there that have carried on a trade or business during 2020. If you have applied for and received one of these PPP loans, the Paycheck Protection Program loans, you are not eligible to claim this credit. And it kind of makes sense because you're getting, money in the form of a forgivable loan that is to be used to pay wages. They're not going to allow you a tax credit against, wage payments that you're using with government money that you don't have to pay back. So then I go back one more slide. Sorry. So the,
one more?
Yeah, thanks. Okay, so assuming that you haven't received a PPP loan, any employer whose operations have been suspended, as a result of a government order, is eligible to use this credit. Additionally, if you haven't been suspended, you're eligible if you've experienced a significant decline in gross receipts during the calendar quarter. So a partial suspension, obviously a full suspension means that your businesses have been closed. Your business has been closed by a government order. But a partial suspension, on the other hand, like what exactly does that mean? So, the government Fed and state governments have imposed a lot of restrictions on the operations of businesses. So the easiest way to explain a I can't say the word suspension, wow. The easiest way to explain a partial suspension is by way of an example. So a restaurant, basically they're ordered closed, so they're not allowed to have people sit in and eat in the restaurants, but they're allowed to operate to the extent that they can continue to, serve the public, with carry out, takeout, or delivery. So that would constitute a partial suspension. But so what about, a business that's still able to operate on a remote basis? Are you partially suspended or you're not partially suspended? How do you qualify for this credit? And this is where the significant decline in gross receipts test comes in. So you're going to measure your gross receipts to see if you have your gross receipts for any particular quarter in 2020 is less than 50% of the gross receipts for the same quarter in the prior year. So as an example, let's say that we're measuring Q2 for 2020 and your gross receipts were $1 million in 2019. If your gross receipts for Q2 2020 are less than $500,000, at that point you become eligible for this employer retention credit. And you continue to be eligible until such time that you have restored or tripped 80% of the gross receipts for the same quarter last year. So again, using Q3 2019 as an example, if you had $1 million of gross receipts, in 2020, if you look at Q3 and your gross receipts are more than $800,000, at that point in time, you are no longer eligible for this credit. Okay, Vinay, next slide. So what wages are we able to use? Again, there's a limited period of time, so it's going to be wage payments, including health benefits that are paid after March 12th and before January 1st. So you would take those wages and that would go into the calculation of your credit. So there's a cap on wages. So it's not 100% of the wages that are paid. It's going to be $10,000 per employee for all quarters. So the way the math works is, since it's a 50% credit, the maximum credit that anybody will get would be $5,000 per employee. So I just want to elaborate a little bit on what this means, $10,000 per employee for all quarters. So let's say that you pay an employee $8,000 of wages per quarter. So Q2 wages are $8,000 and Q3 wages are $8,000. For purposes of Q2, the Q2 credit calculation, you're going to be able to use all $8,000 of those wages. So that would generate a $4,000 credit. But when you move to Q3, because the cap is $10,000, you're only going to be able to use an additional $2,000 of wages for purposes of computing your Q3 credit. Okay. While this credit is available to employers of all sizes, so this isn't just for employees less than 500, employers with less than 500 employees, the number of employees does matter as far as what wages you include. So you look at 2019 average full-time employees, and any business that had more than 100 full-time employees on average for last year is only allowed to include wages that are paid to employees who are furloughed or who have had their hours reduced. And again, this is for wage payments between March 12th and December 31st. If, however, you have on average 100 or less full-time employees, you can include wages on all employees, again, up to that $10,000 cap. And it's not only for furloughed or laid off employees. The other tie-in, just going back to FFCRA, you can't double dip on the same dollars. So if you're paying the mandatory sick payments or family leave payments, those won't count for purposes of computing the employer retention credit. So you're either using one set of wages for one credit or the other. So you can't use the same wages to compute both credits. Okay, next slide. And then going back just to continue the discussion on the FFCRA and how to get the credit. Again, this is the same as we previously discussed. So the credit will, be reported on your quarterly payroll tax return form 941. To the extent the amount of credit, again, as I said before, exceeds the employer's portion of Social Security taxes, that excess can be refunded. You're entitled to, hold off on making any other deposits, and retain your cash, to continue to pay these wages. And again, the Form 7200 can be filed if your credit is going to exceed the amount of payroll taxes that you would otherwise be required to pay in. Just they're amending the second quarter 941 to take into account all of these reduced payments and the advance payments and credits. So that will be coming out soon. And the last point about the Form 7200, the IRS, as Vinay said, a lot of the field offices are closed. So, many forms that have to be paper mailed in are not going to be processed. And the IRS has decided to accept fax. These forms can be faxed in, and the fax number can be found in the instructions to the form or on the IRS website.
And Karen, there was one or two comments in the chat, and I'm going to paraphrase. Ultimately, this is going to require some pretty tight coordination with the business's payroll company, whether you're using a national payroll company or something else. I mean, that's really going to be the important mechanical aspect of getting this benefit.
Yeah, absolutely. I think the sick pay and the family leave payments are probably going to need special coding or something, because they're not subject to certain taxes that regular wages are. So that's a really good point. And anybody who's looking to take advantage of these credits really needs to reach out to their payroll companies, just if for no other reason, to let them know that they're eligible, or that they've made these sick payments and things like that. So yes, that's a great point.
And then I'll just make one other comment about the employee retention credit. This is not a presentation on the Paycheck Protection Program, the PPP, but I have a number of clients that for whatever reason weren't able to get their application in. And now we're really taking a second look at the employee retention credit as being an alternative that they really hadn't considered. And there is quite a bit of subjectivity as to this partial suspension requirement. And I'm hoping that we get guidance, because you could read this a number of different ways as to what constitutes partial suspension for a business. So that's just something that I think is going to become, hopefully there'll be more guidance coming to describe that. So Karen, I think you're going to talk about the payroll tax deferral now?
Yes. So another provision under the CARES Act which again is designed to help businesses keep their cash, is this payroll tax deferral. And the basic gist of this provision is that employers are allowed to defer the deposit and payment, again, of the employer's share of Social Security taxes. So the deferral applies to taxes that, would have to be deposited during the period March 27th, 2020 through December 31st, 2020. So that period of time is referred to as the payroll tax deferral period. So as I mentioned a second ago, Form 941 will be revised for the second quarter. And the revisions will take into account, like I said, those FFCRA credits, the employer retention credits, but it's also going to need to take into account any deferrals under this provision. So unlike the credits that we talked about, which are a permanent benefit to employers, as it's cash that they actually get to keep. This relief provision is a little different in the sense that it's just a deferral. So eventually the taxes will have to be remitted. So that being said, the deferral period is actually pretty generous. So any payments that are eligible to be deferred will be due in 2 equal installments. Half of them will have to be paid by December 31st, 2021, and the other half will have to be paid by December 31st, 2022. And they'll need to be deposited by these 2 dates, and if they're not, there will be failure to deposit penalties imposed. I guess the most important thing to note about this deferral provision is that unlike the employer retention credit, if you've received a PPP loan, you are still eligible for this deferral. However, and this is a big however, once you're notified that all or part of your PPP loan has been forgiven, you can no longer defer any payments of payroll taxes. So the payments that were deferred prior to being notified of, forgiveness, and that's all or part of your loan was forgiven. So anything that you previously had deferred will be due, 50% by 12/31/2021, and the other 50% a year later. Okay.
All right. Thanks, Karen. So let me ask you a question. If I'm self-employed, I'm really paying 2 halves. I'm paying the employer piece and the employee piece, trying to put me on parity with an employer-employee relationship. Mm-hmm. How does that factor into this provision?
Yeah, so that's a good question. Self-employed individuals also have the ability to defer the payment of half of the Social Security tax that's due during this payroll deferral period. So between March 27th and December 31st. Really what this means to a self-employed individual who's calculating quarterly estimated taxes, half of the self-employment tax that you are computing will be able to be deferred, meaning you'll still have to pay in, you'll still be required to pay the balance of your quarterly estimates except for half of the Social Security piece, which will then be due 50% in 2021 and 50% in 2022. So that's a good point about self-employed individuals. Okay.
Good, thanks.
Yep.
So this next slide is starting to give me flashbacks of 2016. So why don't you tell me about net operating losses?
Oh, net operating losses. Okay. So I guess in order to understand what the CARES Act did to the NOL rules, let's go back a ways and just give a little bit of background on the NOLs. So, a couple of years back, that whole Tax Cuts and Jobs Act, was passed, and that was, that big piece of, tax reform that kind of changed everything and rewrote, the majority of the rules that we've come to know and love. But prior to that, businesses were able to, fully offset taxable income with a net operating loss. Additionally, NOLs were able to be carried back for 2 years and forward 20. So now, fast forward, enter tax reform. So TCJA made some pretty significant changes to the rules surrounding the deductibility of NOLs. And as a result of those changes, taxpayers were no longer able to fully offset taxable income with a loss, but instead they were only able to deduct an NOL up to 80% of their computed taxable income. The quirky thing with this limitation, however, is that it only applied to NOLs that were generated in post-TCJA years. So pre-TCJA NOLs, which are those that were incurred years before 1/1, in tax years beginning before 1/1/18, were unaffected by this 80% limitation, and they could still fully offset taxable income even in a post-TCJA year. And as I mentioned, a second ago, the old NOLs were subject to a 2-year carryback and a 20-year carry forward period. And TCJA changed that as well for NOLs starting in incurred in years starting in 2018, and they were no longer eligible to be carried back. So now forget everything that I just told you, because under the CARES Act, the taxable income limitation that was imposed by TCJA is temporarily lifted. And now all NOLs can now be used to fully offset taxable income for tax years 2018, 2019, and 2020. So another favorable change is that under the CARES Act, NOLs for incurred in 2018, 2019, and 2020 can now be carried back for 5 years, okay? Once we hit 2021, everything that TCJA put in place comes back. It comes back, and those are the rules that we have to abide by. But for now, 18, 19, and 20 are going to be pretty favorable. And if you think about what happened as part of TCJA, particularly for corporate taxpayers, we went from a 35% corporate tax rate prior to TCJA down to a 21% tax rate. So if there's an NOL in 2018 or 2019 or even 2020 incurred in a 21% corporate rate year, and you have income in prior years, you can carry back and recoup taxes at 35%. And the last point with respect to NOLs on this slide is that this applies to both corporate taxpayers and individual taxpayers and trusts. The mechanism, I guess, is just a little different. So again, while there's a lot of changes that were made, there's a couple of things that I want to point out here, because some of these NOL rules are a little quirky, if you will. The carryback provisions are mandatory. So you have to carry back an NOL unless you elect not to. I'm not going to get into why this may or may not make sense, but in making this election actually requires you do something. There's an action. And in the case of corporate taxpayers, you can generally check a box on your corporate tax return, whereas other taxpayers will actually need to attach a formal election statement to your tax return. And that election has to be made on the returns filed for the year that the loss is incurred. So that begs the question, well, what do we do with 2018 and 2019, right? 2018 returns, have probably already been, should have been filed already. And, there were some 2019 returns that were probably filed. So, and the other weird thing about this provision is that TCJA eliminated carrybacks for 18 and 19. So we wouldn't have checked the box on a corporate return foregoing the carryback period because there was no carryback period. But now, since the rules are mandatory, we actually are stuck, unless we choose not to be, with carrying back a 2018 net operating loss or a 2019 net operating loss. And the way that if we chose not to follow those rules, if we wanted to elect out, we would have to file an amended return, most likely for 2018, or a superseding return for 2019 if you're still not beyond the extended due date. But in no case can you make this election out after. So let's see how this is confusing. The election out has to be made by the extended due date of the tax return for the first taxable year ending after March 27, 2020, as the slide says. So that's a mouthful. And basically in English, what that means is that taxpayers who want to make this election out have to file an amended return by September 15th or October 15th, 2021, which is the due date, the extended due date of a 2020 tax return. I'm not going to go into a whole lot of detail on the last bullet point here, but for taxpayers who reported repatriation income on their 2017 tax return, 2018 tax return. If you have an NOL now that you want to carry back, or need to carry back to one of those years, you really need to be aware of the potentially negative implications of using an NOL in one of those years to offset repatriation income. And before filing an amended return or a refund claim, you really should talk to your tax advisor, because there's a special election that's available under those circumstances. Okay. Next slide, Vinay. So how do we claim refunds? There's generally two options. You can either file an amended return, or you can file an application for a tentative refund. Depending on the type of taxpayer that you are would dictate which form you use. So an application for tentative refund can be filed either on Form 1139 or Form 1045. And assuming that you're eligible to file this form, it's generally going to result in cash in your pocket within 90 days from filing. But there's two important caveats. The first one is that the refund that you receive is tentative, meaning that it can be reduced because the application is subject to audit by the IRS. The second caveat is that you only have 12 months from the end of your loss year to file this form. So your 2018 return, as an example, if you're a corporation, a C Corp, the due date was October 15th, 2019. If that return reflects an NOL, you have to file that 1139 by December 31st, 2019. So you have a year from the end of the tax year, which was 12/31/18. So obviously that date has passed. So where does that leave us if you can't file the 1139 or the 1045? You can file the amended return, 1120X or a 1040X. So the basic difference is that those amended returns take longer to process by the IRS, but any refund that's issued with an amended return is final. It's not subject to any further adjustment by the IRS, and you have a longer period of time to file those returns. And I skipped over one bullet. Again, because there's a lot of these IRS field offices are closed. The 1139 and the 1045 is generally a form that has to be paper filed, but with nobody physically in the IRS offices to process these forms, the IRS has put a temporary procedure in place allowing taxpayers to fax their tentative refund claims into the IRS, and depending on which series of form that you use, the fax numbers are different. And those fax numbers can also be found on the IRS website.
Okay. Thanks, Karen. So needless to say, when you have a loss, there's a lot of careful multi-year thinking that has to go into if you're going to carry back or carry forward.
Yep, absolutely.
So now I guess we'll talk about a related topic, which is the excess business loss limitation.
Yep.
Or the lack thereof.
Exactly, not anymore. So again, one of the provisions in the TCJA was there was an overall limitation placed on the amount of business losses that could be deducted by individual taxpayers. And the rule basically provided that losses in excess of $500,000 would be disallowed and carried forward as a net operating loss subject to the NOL rules. And that loss limitation was determined after netting all business income and loss items. So as an example, if you operated as a sole proprietorship, and reported your income on a Schedule C, let's say that you had $750,000 of income on your Schedule C, but you also received a Schedule K1 from a partnership that showed a $750,000 loss, you'd generally be able to net the two before determining if you had an excess loss. So under the CARES Act, these loss limitations have been lifted for 2018, 2019, and 2020. So any excess loss can now be deducted. There was also a couple of technical corrections that were made to the TCJA provisions, and probably the biggest one, which doesn't apply for 18, 19, or 20, but it comes into play in 2021, is that wages can't be used to reduce or eliminate an excess business loss. So if you have currently, let's say 2018, your 2018 return shows $1 million W-2 and you have a K-1 showing $1 million loss, you would be able to offset those two to zero and you wouldn't pay tax on any income. But after 2020, those wages cannot be used to absorb the entire K-1 amount. In fact, it won't enter into the calculation whatsoever. So that's something to look out for, as we move through this year and start planning for next year.
So like I said, just like 2016.
Exactly.
In terms of where we're at now. So why don't we talk quickly about the limitation on business interest expense before we turn it over to Len?
Okay, there's nothing quick about business interest expense, but okay.
Give it your best shot.
Well, okay. So again, TCJA kind of changed a lot of things for all of us. And one of the changes that was made was that under the TCJA rules, there was an overall limitation on the amount of business interest expense that could be deducted by a taxpayer. And the limitation was based on 30% of this adjusted taxable income. It's basically, adjusted taxable income is essentially equivalent to EBITDA, at least for 2020 and 2021. So the CARES Act temporarily and retroactively increased the limitation from 30% to 50%. So there's still a limitation, it's just higher. But the change only applies to tax years beginning in 2019 and 2020. So if you've already filed your 2019 return, you have the opportunity to amend and claim this increased deduction should you have been, subject to an overall limitation. And while this is generally a taxpayer-friendly change, there are some taxpayers who might not want to use the increased limitation. And for those taxpayers, there is an election out. And while there's no formal statement that's required to make this election, all you really need to do if you wanted to make this election to use the increased or to use the old limitation is to just file your tax return using the old limitation. Additionally, for 2020, taxpayers can elect to calculate this interest expense limitation using their adjusted taxable income for 2019. So again, this is seemingly beneficial and taxpayer friendly because 2019 adjusted taxable income is likely going to be higher for many taxpayers than 2020 adjusted taxable income. So in addition to being able to use the new 50% threshold, you'll get a higher deduction if your 2019 adjusted taxable income yields a bigger benefit. And again, the election to use 2019 ATI doesn't require anything formal. You elect it simply by doing it. Generally speaking, the 163J rules are applicable to all taxpayers. However, there are special rules that apply only to partnerships. So first, the increased limitation, the 50%, doesn't apply for 2019 to a partnership. So there's no election out. Second, let's assume that you are a partnership and you were subject to a limitation based on 30%. That excess business interest expense gets passed out and allocated to your partners. And generally, under the TCJA rules, the partner is not allowed to deduct that interest expense until the partnership passes out excess taxable income. So under the normal rules, that excess business interest expense is kind of suspended at the partner level. However, under the CARES Act, for 2019, any excess business interest expense that's allocated to the partners is going to be treated, half of it will be treated as fully deductible in 2020 by the partner without any limitation, and the other half will be subject to the regular rules of Section 163J. And like I said, it's going to be suspended until that partnership actually allocates excess taxable income. With respect to the election out of that 50% limitation, partnerships do have the ability for 2020 to elect to use the 30% limitation. And I think that's all I had on the interest expense.
All right, thank you, Karen. I'll let you get a sip of water, and I think Len is going to jump in and tell us about something that people have been talking about for a very long time, QIP.
Thanks, Vinay. And this is certainly one that'll be very exciting to the real estate industry, and many may know about this already, but qualified improvement property was part of the Tax Cuts and Jobs Act, and what it was intended to do was to combine a few categories of real property improvements already qualified for bonus depreciation and expand on the definition also. What was unfortunate is, although the intention was clear and was wanting to allow all these improvements to qualify for bonus depreciation, there was an error in drafting the law where there was a reference to a code section that they also pulled out in another section of the law, which left us with the class life of qualified improvement property to be 39 years instead of 15 years, and thus box it out from bonus depreciation. So I'm just going to give a quick definition of what qualified improvement property is, and then talk about how the CARES Act made a technical correction to the Tax Cuts and Jobs Act to now allow for bonus depreciation to be deducted. So qualified improvement property, also known as QIP, is for non-residential real property improvements only. Doesn't work for multifamily. It's strictly for non-residential. And it's any improvements made to the interior portion of the building placed in service after the date the building is placed in service, with a few exceptions. Enlargements of the building do not qualify. Elevators and escalator improvements do not qualify, nor does work to the internal structural framework of the building qualify. You can flip forward, Vinay. So what the CARES Act did was make the technical correction to now specifically designate QIP as 15-year property. For alternate depreciation system, which becomes important for 163J, which we'll talk about in a minute, it's assigned a 20-year class life. So because QIP now has a class life of under 20 years, it qualifies for bonus depreciation. But what about the impact of 163J? And one thing that was available under 163J is if you were a qualifying real estate trade or business, you can make an election out of being subject to 163J. As you can imagine, having large mortgages and large mortgage interest payments, 163J was going to put an undue burden on many real estate owners if they were going to have their interest expense limited. So you're entitled to this election to elect out of 163J, but the give up for taxpayers was that you're no longer entitled to any bonus depreciation on your real property, and that would box you out from taking bonus depreciation on qualified improvement property. So I imagine that many taxpayers who weren't expecting a technical correction for qualified improvement property may have gone ahead and made this election out of 163J, and now may feel that they're stuck with no bonus depreciation on qualified improvement property, even if they're investing significant dollars in qualified improvements. So I think that gives us some bonus 163J coverage. I'm going to turn it back over to Karen for another moment or two, just to tell us what the IRS did to fix this exact situation.
Yep. So, so as Len said, we now have the ability to look back and we get a do-over. And what may have made sense back in 2018 and 2019, now in light of these new facts, may not make sense anymore. And it's not often that we get, a gift from the IRS to go back and fix, something that, we may have made a different decision on. Had we had all the facts, we can now certainly do that. So again, this applies only to real estate trades or businesses. And we are now able to go back and either undo an election that we made that we don't, that we wish we wouldn't have made, or in certain circumstances, make an election that we may not have made, like make a late election. And there are, we can do this via amended returns. that have to be filed, and the due dates, whether you're making a late election or withdrawing an election, these amended returns have to be filed no later than October 15th, 2021. There are formal statements that will need to be attached to each of those amended returns. And the other piece that's important to note is that as we're amending these returns, we're basically redoing them. So any related calculations, depreciation, the overall, mostly depreciation, I guess, would have to be taken into account. So we're going to redo the depreciation using the lives as they would have been had we either elected or not elected. That's pretty much, I think that's it. So go back and look and see if you can take advantage of this.
Thank you, Karen. And the other thing I should note before we move on to retirement provisions is this does change qualified improvement property going back to 2017. So this would be applicable for 2018 and 2019. So, taxpayers will have the option to either go back and amend an 18 return or a 19 return if they're already filed, or potentially make a change in accounting method to catch up on the depreciation they would have been entitled to. The IRS has relaxed some of the amended return provisions, especially for partnerships where it would have been difficult to do in the past. And we're hoping that we get simplified change in accounting method guidance as well in the near future to help with this process.
Okay. Thanks, Len.
So,
before we move on to, go ahead. I'm sorry, Len.
Nope, I was going to jump into retirement accounts, but if you had a question, we can.
Well, not so much a question. We're at the end of the time. We're going to keep going since we got a late start. We'll probably go another maybe 5 to 10 minutes. We're near the end, so let's just keep at it, Len.
Okay, thanks, Vinay. So we just flip the slide to the next one. So for retirement account provisions, there was 3 main retirement account provisions in the CARES Act, and these are all going to apply to 2020 distributions only. So there was a waiver of the minimum required distribution amount for 2020. So this would allow taxpayers to not draw on that, keep their taxable income down potentially for 2020, and give the IRAs or retirement accounts some money to recover from the dip in the market that we've had. There's also going to be some special treatment for COVID-19 related distributions, and these are going to have to fall into one of 3 categories and are subject to a maximum distribution of $100,000. One is if the individual has been diagnosed with COVID-19, the spouse or dependent of an individual is diagnosed with COVID-19, or the taxpayer experienced adverse financial consequences due to COVID-19. So if this is the case, there's a waiver of the 10% penalty for taking these distributions. There would normally be a 10% penalty on taking distributions out of a retirement account before age 59 and a half. The income can also be spread out ratably over a 3-year period, 2020, 2021, and 2022. So not only are they waiving the penalty, they're allowing you to spread out the tax also, which will hopefully be great for taxpayers that need to take advantage of this. And there's a 3-year extended rollover period for these distributions where you could actually put the money back into the retirement account and not have to pay the taxes on it. Normally it's a 60-day rollover window to be able to do that. So these are all great opportunities for somebody who really needs the money while business may be slower, they may be out of work, to take this out and not have to pay a penalty, spread it over the 3 years, or potentially not to pay any taxes. They put the money back in. Also, when it comes to taking loans from qualified retirement plans, the loans have now been increased to $100,000 up from $50,000, and delays the due date for loan repayments for a full year. The other thing from a planning perspective, Vinay, that we could talk about for a moment or two is this a good time to consider Roth conversions? And what happens with a Roth conversion is you would take a qualified IRA or perhaps a retirement account and roll it into a Roth IRA. And when you do that, you have to pay taxes in the year that the distribution or the conversion takes place. But any future earnings within that account are completely tax-free. So the fact that we have 2 very compelling factors in play right now. If somebody is financially able to do this, you have a depressed stock market right now where the values have really scaled back. Plus, you also potentially have 2020 as a tax year where the income for many taxpayers is going to be reduced as well. So it may be an attractive time to take advantage of the Roth conversion rules, even though you would have to pay taxes on those conversions. What are your thoughts on that, Vinay?
Yeah, I think it's really important, and it's something that everybody should consider. Whether to invest in a Roth or not is an analysis in and of itself that people should be doing. But if you've made that conclusion, then I think that's something that needs to be looked at and also integrated with your estate planning considerations, because there are estate planning angles to this conversion too. So it's well beyond the scope of this webinar, but it is kind of a silver lining to all the negativity that's happening today.
Yeah, so let's flip over to what they did for charities. As you can imagine, charities are another group of organizations that are tremendously impacted in difficult economic times like we have right now, where individuals are trying to keep themselves afloat and don't have the extra funds to contribute to a charity to do good. The IRS has loosened the charitable rules to allow for additional contributions and give incentive for additional contributions. One thing they did when it comes to C corporations is they've raised the 10% limit on net income that they would allow a charitable deduction for up to 25% for 2020, and also have raised the limit for qualifying food inventory contributions, which was at 15% of taxable income, up to 25% as well for 2020. For individuals, for 2020 contributions, the 60% limit, AGI limitation, is disregarded for qualifying contributions, so you can now give up to 100% of your taxable income or your adjusted gross income for qualifying contributions. And generally, qualifying contributions are going to be those made to charitable organizations, with a couple of exceptions. It's not going to be qualified if you're making the contribution to an entity an organization that supports other charitable organizations. You have to give it directly to the charity that's going to use it, nor does contributions to a donor advised fund qualify for this increased limitation as well. Plus, for those that don't itemize their deductions, there's now going to be a $300 above the line deduction that are allowed to these types of taxpayers beginning in 2020 and going forward. So you no longer have to itemize your deductions to get a tax break from making charitable contributions. So hopefully this will help with many of the charitable organizations that are struggling during this time.
So
and then the last thing,
the most important thing, the checks.
So the stimulus checks are certainly a hot topic, and it's really a stimulus credit for 2020, but they're giving everyone advance payments in the form of checks or direct deposits during 2020 if you would have met the criteria based on 2018 or 2019 tax filings. And the way the calculation works out, it's $1,200 for each eligible individual, $2,400 for married filing joint, plus $500 for each qualifying child of a taxpayer. And a qualifying child is those that are under 17 and qualify for the child tax credit. The advance payments during 2020 should have started this week, so some taxpayers may be seeing these already. Unfortunately, this isn't for everyone. It's only going to be deemed for those that have low or moderate income. For an individual that's filed as a single taxpayer, the phase out of any benefit begins at $75,000 and is completely phased out at $99,000. For an individual that's married filing joint, it starts at $150,000 and is phased out fully by $198,000. And one of the questions that comes up is, well, if this is based on 2018 or 2019 filings, what if a person didn't have a tax filing obligation? They were below the income thresholds. I imagine this probably would impact a number of elderly people who are only collecting Social Security. There is a way to go to the IRS website and certify your information so that you can receive one of these advance payments during 2020. And the IRS is working with Social Security and some other organizations in order to verify this information to provide these taxpayers with the benefit that they're entitled to receive without actually filing a tax return. And I think that's everything for me, Vinay.
All right. Len, thank you. Karen, thank you. On behalf of Len and Karen, we want to thank you for joining us. We went over a bit. I do apologize for the technical glitch at the beginning. We have a number of questions. I think in the interest of time, we're going to respond to those on an individual basis. Our contact information is here if you want to reach out to any of us individually. And we thank you for joining us.